Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Haemonetics Corporation quarterly report. Haemonetics Corporation offers a diverse range of medical technologies and services to hospitals worldwide. At the forefront are their automated plasma collection systems, including Nexus PCS and PC Estwo plasmapheresis equipment, which provide efficient donor management and supply chain solutions through integrated information technology platforms. In addition to plasma collection, Haemonetics provides treatment solutions in various specialties such as electrophysiology, critical care, neurocritical care, trauma, burn surgery, spine surgery, and cancer surgery. Their innovative products include SavvyWire, a sensor-guided guidewire for TAVR procedures, and OptoWire, which measures fractional flow reserve and diastolic pressure ratio. The company also offers hospital products like TEG and has hemostasis analyzer systems that provide comprehensive assessments of patients' overall hemostasis. Their TEG Manager software enables remote access to test results, informing treatment decisions. Furthermore, Haemonetics provides Cell Saver Elite Plus, an autologous blood recovery system for various surgeries. Haemonetics also offers VASCADE closure products, including catheter-based delivery systems that leverage the natural clot-inducing properties of collagen. These products are sold through a variety of channels, including direct sales force, independent distributors, clinical specialists, and sales representatives. Unfortunately, I do not have access to the text you provided. However, I can provide a general overview essay on what may cause Haemonetics Corp stock price to increase. Haemonetics Corp is a leading provider of blood management solutions for hospitals and healthcare systems worldwide. The company's stock price has seen an increase in the past year due to several factors. One major reason is the growing demand for its products, particularly in emerging markets such as Asia and Latin America. As these regions continue to develop their healthcare infrastructure, Haemonetics Corp is well positioned to capitalize on this trend. Another factor contributing to the company's stock price increase is its strong financial performance. Haemonetics Corp has consistently reported robust revenue growth and expanding profit margins, demonstrating its ability to execute on its business strategy. This stability and growth have likely attracted investors seeking stable returns in a volatile market. Additionally, the company's focus on innovation and research and development has led to the introduction of new products and technologies that are driving growth and expansion into new markets. Haemonetics Corp's commitment to improving patient outcomes through its blood management solutions is also resonating with healthcare providers and payers, further boosting demand for its products. Overall, a combination of growing demand, strong financial performance, and innovation have contributed to the increase in Haemonetics Corp's stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, the acquisition of Vivazure Medical Limited has been a significant contributor, allowing the company to expand into new markets with Vivazure's products. Additionally, the integration of these products into the company's hospital business unit is expected to generate synergies and drive sales growth. The PerQseal Elite system from Vivazure also holds potential for increased sales. Furthermore, the company has experienced growth in U.S. plasma collections and innovation benefits, as well as pricing benefits from its hemostasis management product line. On the decline side, several factors have contributed to revenue decreases. The divestiture of the whole blood product line has resulted in a 2.7% impact on blood center revenue. Lower sales volumes in North America, primarily due to customer transition of CSL plasma, have also been a significant factor. Furthermore, the divestiture of the whole blood product line and lower sales volume in interventional technologies franchise have contributed to revenue decline. The company's financial performance has shown a positive trend in terms of net income and profit margins. Net income has increased significantly, rising from $109,698 in YTD 2024 to $117,455 in YTD 2025, representing an increase of $7,757. This growth can be attributed to various factors, including the issuance of restricted stock worth $250,000 $532, and a decrease in shares repurchased by $26,047. Furthermore, profit margins have also improved. The gross profit margin has increased from 55.6% in Q3 2024 to 59.7% in Q3 2025, while the operating income margin has risen from 16.9% to 19.9%. These improvements can be attributed to pricing benefits across all business units and a decrease in restructuring costs and amortization of fair value inventory step-up. The overall increase in net income and profit margins is a result of a combination of these factors, which have contributed to the company's improved financial performance. The company's financial performance indicates a strong ability to generate cash from its core operations. The net cash provided by operating activities for the period ending December 27, 2025, was $222,280, a significant increase of $157.1 million compared to the previous year. This positive trend is consistent with the company's overall financial health, demonstrating its capacity to produce cash from its daily business activities. The company's debt level and interest expenses have remained relatively stable over time. While some specific changes are noted in certain financial metrics, such as an increase in designated foreign currency hedge contracts and a decrease in net debt position, these fluctuations do not indicate any significant shift in overall debt levels or interest expenses. The interest expenses for the term loan also show a notable increase from $4.1 million to $12.6 million, but this change is isolated and does not suggest a broader trend of increasing debt or interest costs. The company's performance varied across different segments and regions. On the positive side, the hospital business unit showed strong results, as did the developed technology segment. The plasma segment also performed well, with notable mentions on pages 39, 41, and 44. Additionally, the blood management technology segment within hospital was successful, while Vivasure also demonstrated good performance. However, some segments struggled. Electrophysiology and vascular closure product line were among the poorly performing areas. Customer contracts and relationships also faced challenges, as did the hospital business unit due to an impairment charge related to HAS viscoelastic diagnostic devices. The blood center business unit's whole blood segment underperformed, while the plasma segment experienced a decline due to customer transition of CSL plasma. In terms of regions, Japan, Europe, rest of Asia, and other regions all performed well. In contrast, the United States saw a slight decrease in long-lived assets, indicating a less successful performance compared to other regions. Management's outlook for the company is optimistic, with several key strategies in place to drive growth. The adoption of ASC Update number 2023-9 is not expected to have a material impact on financials. Management has exited non-core business segments and is focused on strategic investments, including the acquisition of Vivasure. The company's growth potential lies in its plasma and hospital divisions, with targeted opportunities in challenging markets for the blood center division. To achieve this growth, management plans to invest in strategic acquisitions and product innovation. Research and development expenses are expected to increase due to these investments. Management is confident in the company's liquidity sources, which will be sufficient to fund cash requirements over at least the next 12 months. The company has a strategy for digital transformation and is making strategic investments, repurchasing shares, reducing debt, and aiming to achieve long-term growth and improvement goals. However, management also acknowledges potential risks from market acceptance and demand for new products, competitors, and regulatory changes. To mitigate these risks, the company will focus on executing its strategic investments and developing and marketing new products successfully. The company has made several strategic moves through acquisitions and divestitures in recent years. In terms of acquisitions, the company has invested heavily in expanding its portfolio. Notably, it acquired Attune Medical for $150.9 million, as well as OpSens Inc. and Vivasure. These acquisitions are expected to bring significant benefits to the company's operations and growth prospects. On the other hand, the company has also engaged in divestitures to optimize its assets and reduce costs. Specifically, it sold some of its property, plant, and equipment, resulting in a partial offset of $20.8 million in fiscal 2025. Although no specific amount was mentioned for fiscal 2026, this move is likely aimed at streamlining operations and improving efficiency. Concerns about inventory buildup and supply chain disruption have been raised. Inventory buildup is a significant issue, with specific amounts of $12,075 and $26.4 million being mentioned as part of the problem. The company has also recognized inventory reserves of $717,000, indicating that they are taking steps to address the issue. The increased outflows for inventory and non-cash transfers from inventory suggest that the buildup is a persistent problem. Furthermore, disruptions to the supply chain have been identified, including issues with raw materials, finished goods, and components used in manufacturing. These disruptions could be contributing to lower sales volumes in North America for plasma revenue. Overall, these concerns highlight potential risks to the company's operations and profitability. That concludes the financial summary for Haemonetics Corporation. Feel free to comment below, and I will be happy to answer them when possible.